Hello, friends. If you were 65 or older in 2025 and you already filed your federal tax return, pull out that return before you assume the job is finished. The IRS has confirmed a new enhanced deduction worth up to $6,000 for each eligible senior. If a married couple files jointly and both spouses qualify, the maximum can be $12,000. But here is the part that is already causing confusion. This is not a $6,000 check. It is not a refundable credit. It does not mean the IRS automatically sends every senior $6,000. It is a deduction that can reduce taxable income, and the actual tax savings depend on your income, filing status, tax bracket, and whether you had taxable income to reduce. That distinction matters because some people are expecting a deposit that will never arrive, while other people may have missed a legitimate deduction on a return they already filed. Today, I am going to show you who qualifies, why married couples can lose the deduction by using the wrong filing status, how the income phase-out works, where the deduction appears on the return, and what to check if your tax preparer or software did not include it. Stay until the end, because the most important group may be people who filed early and never saw the new Schedule 1, a calculation on their return. Before we begin, subscribe and turn on notifications. Tax headlines often sound simple until one missing rule changes the answer completely. On this channel, I go through the official IRS guidance and explain what the rule actually does, who it helps, and what action is worth taking. Let us start with the basic facts. The enhanced deduction for seniors applies for tax years 2025 through 2028. That means it first appeared on 2025 federal income tax returns filed during the 2026 filing season. The maximum is $6,000 for one eligible person. For a married couple filing jointly, the maximum is $12,000 when both spouses are eligible. The deduction is in addition to the existing higher standard deduction available to older taxpayers. It does not replace the regular standard deduction, and it does not force you to choose between the new deduction and itemizing. That last point is unusual and valuable. Eligible taxpayers can claim the enhanced senior deduction whether they take the standard deduction or itemized deductions on Schedule A. So, who qualifies? For the 2025 tax return, the individual claiming the deduction generally had to be age 65 by the end of 2025. The IRS instructions express that rule by saying the person must have been born before the 2nd of January. 1961. The reason for the January 2nd language is an old tax rule that treats a person as reaching age 65 on the day before the 65th birthday. For most viewers, the simple question is this: were you treated as age 65 by the end of the tax year? For future tax years, use the same idea. The deduction is available for tax years 2025 through 2028, but the age test is applied separately each year. Someone who is too young for the 2025 deduction may qualify on a later return after reaching 65. The next requirement is a valid Social Security number. The person claiming the deduction must have an SSN that meets the IRS requirement. On a joint return, each spouse claiming the deduction must have a valid SSN. Now, we reach the rule that could disqualify a married taxpayer even when the age and income numbers look perfect. If you are married, the IRS says you must file a joint return with your spouse to claim this enhanced deduction. Married filing separately does not qualify. That means a couple should not look only at the $12,000 headline and automatically change filing status. Filing jointly affects the entire return, not just this deduction. There can be reasons some couples file separately, including income-based programs, liability concerns, student loan calculations, or state tax issues. The correct move is to compare the complete federal and state result under the filing statuses legally available to you. Do not change filing status based on one deduction without reviewing the whole picture. Now, let us talk about income. The full deduction begins to phase out when modified adjusted gross income exceeds $75,000 for a single filer, head of household, or qualifying surviving spouse. For married couples filing jointly, the phase-out begins above $150,000. The words "begins to phase out" are important. Crossing the threshold by $1 does not instantly erase the entire deduction. The allowable amount is gradually reduced as modified adjusted gross income rises. That also means the headline amount is a maximum, not a guarantee. A single taxpayer with modified adjusted gross income below the threshold may qualify for the full $6,000. A taxpayer above the threshold may receive a smaller deduction. At a sufficiently high income, the deduction can disappear. Your modified adjusted gross income for this calculation comes from Schedule 1A. It may not be the number you casually think of as take-home income. Retirement distributions, taxable Social Security, investment activity, business income, and other items can affect adjusted gross income and the final calculation. This is one reason a large Roth conversion, capital gain, or retirement account withdrawal can reduce the deduction. The withdrawal may be completely legal and financially sensible, but it can raise income used for the phase-out. That does not automatically mean the transaction was a mistake. It means tax decisions interact. A good plan considers the deduction, Medicare income-related premiums, taxation of Social Security, capital gains, required distributions, and future tax rates together. Now, what is this deduction actually worth? A deduction reduces income subject to tax. A credit generally reduces tax dollar for dollar. Those are not the same thing. Imagine an eligible taxpayer receives the full $6,000 deduction and is in a 12% marginal federal tax bracket. $6,000 multiplied by 12% is $720. That is a simplified illustration of the potential federal tax reduction, not a promised refund. At a 22% marginal rate, the simplified value of a $6,000 deduction could be $1,320. For a couple receiving the full $12,000 deduction, the simplified value at a 12% rate could be $1,440. At a 22% rate, it could be $2,640. Real returns are more complicated. The deduction can affect taxable income across tax brackets, and other calculations may also change, but these examples explain why $6,000 of deduction is not the same as $6,000 in cash. If your taxable income is already zero, an additional deduction may produce little or no immediate federal income tax benefit. The deduction is not designed to create a $6,000 payment when no tax would otherwise be owed. That does not make the deduction unimportant. For someone paying federal income tax, it can be meaningful. It simply has to be described honestly. Now let us look at where it appears. The IRS created Schedule 1A, Additional Deductions. For several new deductions, the enhanced senior deduction is calculated in Part V of that schedule. Schedule 1A is attached to Form 1040, Form 1040 SAR, or Form 1040 NR when applicable. The resulting additional deduction flows into the federal return and reduces taxable income. Do not assume that using Form 1040 SR automatically gives you the deduction. Form 1040 SR is a tax form designed with older taxpayers in mind, but the enhanced deduction still has eligibility rules and a calculation. The age of the form user does not replace Schedule 1A. Here is the first practical check. Find your filed 2025 federal return. look for Schedule 1A. Then look for Part V, Enhanced Deduction for Seniors. If that schedule is present, review the age boxes, Social Security number requirements, filing status, modified adjusted gross income, and deduction amount. If Schedule 1A is missing, that does not automatically mean the return is wrong. You may not have qualified. Your income may have phased out the deduction, or the information may appear in an electronic return summary from your software. But if you were eligible and the deduction was omitted, you may need to correct the return. The IRS uses Form 1040X to amend an individual income tax return. Amended returns can correct deductions and other items on a previously filed Form 1040 or 1040-R. Do not file an amended return just because a video told you to. First, compare the original return with the Schedule 1A instructions or ask the preparer who filed it. An unnecessary amended return can create delay and confusion. But do not ignore the issue either. If an eligible deduction was genuinely missed, an amended return may reduce tax, increase a refund, or reduce an unpaid balance. Here are 5 situations worth checking. Situation number 1. You turned 65 during 2025 and your software did not recognize the age rule correctly. Situation number 2. Both spouses qualified, but only one $6,000 amount was included on the joint return. Situation number 3. You itemized deductions and someone incorrectly told you the enhanced deduction was available only to people taking the standard deduction. Situation number 4. You filed early with software or a preparer that did not correctly complete Schedule 1A. Situation number 5. You are married and filed separately without realizing that the enhanced deduction requires a joint return. That 5th situation is the most complicated. Amending from separate returns to a joint return can have consequences beyond this deduction. Both spouses become responsible for the joint return, and state returns may also need attention. That is a case where professional advice can be especially valuable. Now, let us clear up several claims you may hear online. Claim number 1. Every senior gets $6,000. False. The maximum deduction is $6,000 per eligible person. It is not a direct payment, and income can reduce the amount. Claim number 2. Social Security is now tax-free for everyone. False. The enhanced deduction can reduce taxable income, but the tax rules for Social Security benefits were not replaced by a universal exemption. Depending on combined income and filing status, part of Social Security may still be taxable. Claim number 3. You cannot claim it if you itemize. False. The IRS says eligible taxpayers can claim the deduction whether they take the standard deduction or itemize. Claim number 4. A married senior can claim it on a separate return. False under the IRS eligibility rules. A married taxpayer must file jointly to claim the enhanced senior deduction. Claim number 5. The deduction is permanent, not under the current law. It applies for tax years 2025 through 2028 unless Congress changes the law. That temporary window is important. Tax planning for one of these years may not work the same way after 2028. For example, someone deciding when to recognize income might consider whether a transaction pushes modified adjusted gross income into the phase-out range. But tax planning should never focus on preserving one deduction while creating a larger cost elsewhere. Paying an advisor thousands of dollars or making a poor investment decision to protect a deduction worth hundreds of dollars would not make sense. Always compare the complete after-tax result. Here is a simple checklist. First, confirm the age test for the tax year. Second, confirm the filing status. Married taxpayers must file jointly. Third, confirm that each eligible spouse has the required valid Social Security number. Fourth, calculate modified adjusted gross income using the official Schedule 1A instructions rather than guessing. Fifth, Determine whether the deduction is $6,000, $12,000, a reduced amount, or zero. 6. Remember that the deduction can be used by both standard deduction and itemizing taxpayers. 7. Check the filed return for Schedule 1A, Part V. 8. If the deduction appears to be missing, compare the return with the official instructions before filing Form 1040X. And finally, keep copies of the original return, amended return, schedules, and supporting documents. One more point matters for people who have not filed. An extension to file is not an extension to pay. If tax was due for 2025, interest and possible penalties can continue even when you received extra time to submit the return. The senior deduction may lower the final amount, but it does not erase normal filing and payment rules. For people planning the 2026 tax return that will be filed in 2027, start now. Keep records of retirement distributions, investment sales, Social Security forms, pensions, business income, and any other items that may affect modified adjusted gross income. The headline is real. Eligible taxpayers age 65 and older may claim an additional deduction of up to $6,000 or up to $12,000 for a qualifying married couple filing jointly. But the real opportunity is not waiting for a government check. It is making sure the deduction is correctly calculated on the tax return. Take out your return. Find Schedule 1A. Check Part V. Verify the age, filing status, Social Security numbers, and income calculation. If everything is correct, you are done. If the deduction was missed, speak with the preparer or review Form 1040X before the issue is forgotten. Share this video with a parent, spouse, neighbor, or friend who was 65 or older in 2025, especially someone who filed early or prepared a return without professional help. Subscribe for verified Social Security, Medicare, retirement, and tax updates explained in plain English. I will see you in the next video.